Hello everyone and welcome to Study IQ English. I am Joycey Joy. In this video, we will be discussing about the receipt side of the budget. So, we will take up the receipt side of the budget. As we know, there are two sides or there are two parts in a budget, that is the receipts and also the expenditure. These are the two heads in a budget. And receipts can be further capital receipts or revenue receipts. Expenditure can be further capital expenditure or revenue expenditure. In another video, we'll be discussing about the expenditure side of the budget. But in this video, we'll be discussing about the receipt side of the budget. And under receipts, we will discuss about capital receipts and also the revenue receipts in a budget. In the year 2021, that is in the latest mains examination, there was a question relating to capital budget and revenue budget and what is the difference between capital budget and revenue budget. So in capital budget you have to discuss about capital expenditure and capital receipts, and in revenue budget you have to discuss about revenue receipts and revenue expenditure. So expenditure and receipts in a budget are very important, and in this video we'll be discussing about the receipt side of the budget. Getting started. Now coming to receipts, receipts can be further divided into revenue receipts and capital receipts. These are the two broad classification of receipts. It can be either revenue receipts or it can be capital receipts. Further, revenue receipts can be divided into tax revenue, non-tax revenue and other non-tax receipts. So these are the three other classification of revenue receipts. If the receipts are from the levy of taxes, we call it as tax revenue. From non-tax sources, it is called non-tax revenue, and other non-tax receipts. These are the three further classification of revenue receipts. Further, capital receipts can be either debt capital receipts or non-debt capital receipts. Debt capital receipts are those capital receipts that create a debt obligation for the government. That is, the government has to repay it. So, debt obligation means a repayment obligation for the government. Non-debt capital receipts are those capital receipts which does not create a debt burden for the government. No debt burden for the government. So we will be discussing about all of this in detail. Let's get started. First coming to revenue receipts. Within receipts, first coming to revenue receipts. Now, as we said, revenue receipts can be further divided into tax receipts, non-tax receipts and other non-tax receipts. Now, first coming to tax revenue. Tax revenue is the revenue that the government collects or the government gets from levy of various taxes. By levying various taxes, by imposing various taxes and duties, whatever revenue the government accrues, that is the tax revenue. Now, examples of tax revenue: union excise duty, then goods and services tax, that is GST, customs duty on import and export of commodities, corporate tax on the profit of corporates or companies, income tax on the personal income of individuals, taxes of union territories, and other taxes and duties. These are all examples of tax revenue. From these examples, you understand that tax revenue refers to the revenue that the government gets from the way of or by the way of collecting or levying taxes from the public. That is tax revenue. So a major source of revenue for the government is tax. So tax is a major source of revenue, and tax revenue becomes a major component of the total receipts of the government. Next is non-tax revenue. So within non-tax revenue, there are two major sources from where the government gets non-tax revenue. From the name itself, it is clear. These are revenue that the government gets from non-tax sources. That is, from ways other than collecting taxes, from other means other than taxes. So that is interest receipts and dividends and profit. These are the two major sources of non-tax revenue that the government gets. Now, what are interest payments or interest receipts? Interest receipts are those receipts the government gets from those who have a debt obligation towards the government. That is, in the past years, if the government has given loans to international organizations or other countries or other entities, that is, the loans given by the government earn some interest for the government. Now, if you give loan to someone or when you take a loan, you have to pay interest on it. Similarly, when the government give loans to someone, that someone or that entity, the country or the multilateral institution or that entity has to pay interest to the government. So that is an income for the government. That is interest received by the government on the loans given by the government. That is the interest receipt. Next is dividend and profit. Dividend refers to the share of profit government earns from those companies in which government has a share. So those entities where government has a shareholding, government receive a part of the profit. That part of profit the government earns from those companies or entities where government has a shareholding is called the dividend. Now, profit refers to the profit government earns from government undertakings like the public sector undertakings, public sector banks, or the profit share of RBI. All these are the profit earned by the government. So dividend and profit is another major non-tax revenue for the government. Next is other non-tax receipts. That is those receipts government receives other than taxes and also other than interest and dividend and profit. Fiscal services, other general services, social services, economic services. All these kind of services are provided by the government. And for rendering these services, the government receives some fees. So all these fee comes in the form of non-tax receipts, others or other non-tax receipts. Then grants and aid contribution. So grants and aid contribution means if any country or if any international institution give grants to the government, then it is a non-tax receipt. Why it is a receipt and it's a revenue receipt, not a capital receipt? Because it's a one-way transaction. Which means that grants are unlike loans, that the grants need not be paid back. Loans has to be paid back. They are debt obligations or they are borrowings which needs to be paid back. But grants are those obligations for the government where there is no obligation for repayment. They are help or aid to the government which need not be repaid. That's why grants come under revenue receipts, not capital receipts. If it was a borrowing or a loan, it would have come under the capital receipts. Whereas grants are help or aid received from some other entity, it need not be paid back and they are necessarily one-way transactions. That's why they come under revenue receipts. Next is non-tax receipts of union territories. Why union territories? Because union territories comes under the administrative control of the central government except the union territories of Puducherry and Delhi. So all other union territories other than Puducherry and Delhi comes under the administrative control of union government. That's why the non-tax receipts of the union territories also belongs to the union and it is seen or it's shown in the union budget. Next we come to capital receipts. So capital receipts are two-way transactions and also they are long-term in nature. Revenue receipts are one-way transaction and capital receipts are two-way transaction. Capital receipts can be further divided into debt-creating capital receipts and non-debt-creating capital receipts. Debt-creating capital receipts refers to those capital receipts for which there is a repayment obligation. That is, they are debt. They create a debt burden on the government and the government need to repay it later. That's why they are two-way transaction. They need to be settled. So they are debt-creating capital receipts. Debt-creating capital receipts can be further divided into borrowings and other liabilities. Now, borrowings means the money that the government borrow from various sources. It can be from public, that is internal borrowing, or it can be external borrowing. If the government borrows from one country, it is called bilateral borrowing. If it's from an international organization, it is further called as a multilateral borrowing. Bilateral and multilateral borrowing. So borrowings can be either external or internal borrowings. Borrowings either internal or external. So external can be further classified as bilateral borrowing and multilateral borrowing. And other liabilities. Liabilities other than borrowing. Then there are also non-debt capital receipts. Non-debt capital receipts are those capital receipts for which there is no debt obligation, which means that it need not be repaid. No debt obligation. No debt obligation means there is no need for repayment. There is no repayment obligation. That is non-debt capital receipts. So, debt capital receipts and non-debt capital receipts. That is within the capital receipts. Now, let's come to borrowings. Borrowings is a part of debt creating capital receipts. Borrowings can be, as I said, internal borrowings and external borrowings. Now, internal borrowings refers to those borrowings which takes place within the country. If the government borrows money from sources within the country, it is called internal borrowing. And if the government borrows from sources outside the country, it is called external borrowing. So, internal borrowings can be in the form of market loan. How market loans can be raised by the government? By the issue of government securities. Government securities is an entirely different topic which we will discuss in a different video. So, market loans can be raised by the government by the issue of government securities, which are called GSEC. GSEC is government security. So, market loans. Next one is treasury bills. Treasury bills are also financial instruments or debt instruments issued by the government to the general public to raise money. And what makes treasury bills and government securities different is that government securities are long-term instruments whose maturity period is more than 1 year. Treasury bills are short-term instruments whose maturity period is less than 1 year and maximum is 364 days. And that's why we call treasury bill as a money market instrument. Money market instrument are those instruments for which the maturity period is less than 1 year. So here the maturity period is less than 1 year and therefore it's a money market instrument. Now coming to other internal debt. There are other forms of internal debt like funded security, other securities issued by RBI, cash management bills, ways and means advances, market stabilization scheme, special floating and other loans, securities against small savings, compensation bonds and others, non-negotiable, non-interest bearing securities issued to internal financial institutions, etc. So these are all different kinds of other internal debt. Next is external borrowing. So external borrowing, as we said, it can be bilateral loans or multilateral loans. What are bilateral loans and what are multilateral loans? Bilateral loans are the loans taken from one country. That is, if India borrows, if the government borrows money from one another government or one country itself, it is called bilateral loan. Multilateral loans are those loans taken from multilateral institutions. Multilateral institutions, for example, World Bank, IMF, World Economic Forum, etc. Then bilateral loans are those loans taken from other countries. That is country to country loans. Now other liabilities. So what are the components of other liability? Small savings scheme, provident fund, other accounts, reserve fund. These are all components of other liabilities. So these are also liabilities for the government. Why? Because there is a repayment obligation. These also needs to be repaid. These are called liabilities because there is a repayment obligation. So there is a repayment obligation from the side of government. That's why they are liabilities. Now, non-debt capital receipts. Non-debt capital receipts are those receipts for which there is no repayment obligation. They are not debt for the government, which means there is no repayment obligation. Government need not repay it back. There are two major sources from which government gets the non-debt capital receipts. One is recovery of loans and advances. Those loans government had given in the past, if it is repaid by those entities, then it is a capital receipt for the government. That is recovery of loans. Those loans given by the government earlier in the past is repaid by the entities. That is non-debt capital receipts. Another one is disinvestment of government shares other than PSUs. So disinvestment of government shares other than PSUs. Why? Because the sale of shares from the PSUs, it goes to a entirely different fund. It does not come under this. It goes to a entirely different fund. So that's why other than PSU. So disinvestment means sale of government shares. Disinvestment of government shares other than that of PSUs is included in the non-debt capital receipts. So these are the non-debt capital receipts, and this is the receipt side of the budget. I hope the receipt side of the budget is very much clear for you now. Thank you so much for watching. I wish you all the very best.